Issue forfeiture and reissue of forfeited shares. Introduction. Two major limitations of sole proprietorship concern and partnership firms are inadequacy of funds and unlimited liability. To overcome these limitations, one of the most inconvenient form of organization that grew with expansion of business requiring huge funds is the joint stock company form of organization. In India, joint stock companies are governed by the provisions of the Companies Act 2013. Meaning of a company. A company is a voluntary and autonomous association of certain persons with capital divided into numerous transferable shares formed to carry out a particular purpose in common. It is an artificial person created by law to achieve the object for which it is formed. Section 2 subsection 20 of the Companies Act 2013 defines a company as company means a company incorporated under this act or under any previous company. An existing company means a company formed and registered under any of the former Companies Act. Company is an abstract person, invisible, intangible, and existing only in the completion of law. It can hold, purchase, or sell both movable and immovable property, incur and pay debts, open a bank account in its one name, and sue and sued in the same manner as an individual. Law create it, and law only can dissolve it. Its existence is altogether independent of the life of its members. Members may come and go, but the company would go on forever. Transferability of shares has given perpetual succession to a company. Death, insanity, or insolvency of a member or any member will not affect the existence of the company at all. A company is a legal entity quite distinct and separate from the persons who are its members. A company can buy its own shares under certain conditions. A company shareholder is not the agent of the company. He cannot incur any debts so as to bind the company. Shareholders cannot bind the company by their acts. The same person can be shareholder and a creditor of the company. The ownership is still divorced from management because a joint stock company is managed by a board of directors elected by the shareholders owner. Characteristics of company. It is a distinct legal person, quite distinct and separate from its member. It has an independent existence. Liability of the members is limited to the extent of the face value of shares held by them. It has a perpetual succession. The members of the company may keep on changing from time to time, but this does not affect the company's continuity. The shares of a company are freely transferable except in case of private limited company. A company being a legal person is capable of owning, enjoying, and disposing the property in its own name. A company being a separate body can sue and be sued in its own name. Through a company is an artificial person, yet it acts through human beings who are called directors of the company. There is a divorce between the ownership and management. It is a voluntary association of persons formed usually for profit. A company can buy its own shares under the certain conditions. Kind of companies. From the point of view of a formation, companies are of three kinds: chartered companies, statutory companies, and registered companies. Chartered companies, those companies which are incorporated under a special charter by the king or sovereign, such as East India Company. Such companies are rarely formed nowadays as a trading company. Statutory companies, these companies are formed by a special act of legislature or parliament. The Reserve Bank of India, the Industrial Finance Corporation, Damodar Valley Corporation, etc. Registered companies, such companies which are incorporated under the Companies Act 2013 or registered under the previous Companies Act. From the point of view of liability, there are three kinds of companies: limited companies, guarantee companies, unlimited companies. In case of such companies, the liability of each member is limited to the extent of his value of shares held by him. Suppose he takes a share of 10 rupees, he remains liable to extent of that amount. As soon as that amount is paid, he is no more liable. Guarantee company. The liability of the members of such companies is limited to the amount he has undertaken to contribute to the asset of the company in the event of its wound up. This guaranteed amount is limited by fixing sum which is specified in the memorandum. Chambers of the Commerce, Trade Association and sports clubs are usually guarantee concerns. The object of such companies is not to make profit and distribute dividends. Unlimited company, they are nothing but large partnership registered under the Companies Act, and the members, just like partners, have unlimited liability, and both their shares contribution as well as their private property are at stake when the company is to be owned of. Such companies are rare these days. One-person company. The one-person company is a new concept under the Companies Act 2013, Section 2, subsection 62 of the Companies Act defines one-person company as a company which has only one person as a member, or one person company is required in indemnify in its name in bracket as one person company after its name as per section 3 subsection 1c. One person company will be formed as a private company and will comply by subscribing his name to a memorandum and comply with the requirement of the Companies Act 2013 in respect of registration of the company. The memorandum, one person company shall indicate the name of other person which with his prior consent in the prescribed form, who shall, in the event of the subscriber death or his incapacity to contract becomes the member of the company, and the written consent of such person shall also be filed with the registrar at the time of incorporation of the one person company along with the memorandum and articles. From the point of view of a public investment, companies may be of two kinds. Private companies. A private company means a company which by its article restricts the right of transfer its shares, if any, limits the number of its members to 200, excluding past or present employee of the company who are also members of the company, prohibits any invitation to the public to subscribe for any shares in or debentures of the company. A private company should by its article prohibit any invitation or acceptance of deposit from persons other than its members, directors and their relatives. It can have a minimum paid up capital of 0 or such higher capital as may be prescribed. If any deviation is made in this regard, then such a company will as to be a private limited company. Public companies are those companies which are not private companies. All the four restriction of a private company are not imposed on such companies. It has a minimum paid up capital of 5 lakh or such higher paid up capital as may be prescribed, but as per Companies Amendment Act 2015, it can have zero capital. A private company which is a subsidiary of a public company is also to be taken as a public company. Company is deemed to be public. A private company will be deemed to be public company in the circumstances given below. If 25% or more than its paid up share capital is held by one or more body or more bodies corporate, or if it holds 25% of the paid up share capital of a public company, or if its average annual turnover is not less than rupees 25 crores, or if it invites deposit from the public or renews deposit from the public other than its members, directors or their relatives. Difference between private limited company and public limited company. Following are the main points of distinction between a private limited company and a public limited company. Minimum number of members. The minimum number of members of to constitute a private company is 2, but a public company cannot be formed unless there are at least 7 members. The Companies Act 2013 has also introduced concept of one person private company. Maximum number of members. The maximum number of members in case of a private company is 200, but there is no limit. But there is no maximum limit of members for a public company. It can have member equal to the number of shares issued by it. Minimum requirement of capital. A private company must have a minimum paid up share capital of 1 lakh rupees or such higher paid up share capital as may be prescribed, whereas a public limited must have a minimum paid up share capital of 5 lakh rupees or such higher paid. Up share capital as may be prescribed, but as per Amendment Act 2015, both companies have zero capital. Issue of prospectus: a private company cannot invite public to subscribe to its shares or debentures by issue of a prospectus, but a public company must issue a prospectus or a statement in lieu of prospectus for inviting public to subscribe to its shares or debentures. Membership of a private company is restricted to friends because it cannot invite public to subscribe to its shares. The transfer of shares is generally restricted by the articles of association. A private limited company, but the shares of a public company are freely transferable by following a procedure to transfer. Commencement of business: a private company can allot shares and commerce business after getting the certificate of incorporation from the registrar of companies, but a public limited company cannot allot shares unless it has collected minimum subscription and has received at least 5% of the nominal amount of share applied in cash on application. It can commence business only after getting the certificate of commencement of business as per recent guidelines issued by the central government. The minimum subscription is the case in case of public or right issue of shares or debentures has been fixed at 90% of the entire issue. Such subscription must be raised within 90 days of the close of issue. Number of directors: a private limited company must have at least 2 directors, whereas a public limited company is required to have at least 3 directors. Quorum for meetings: the quorum for a meeting of a private company is 2, while 5 members constitute a quorum in case of a public company. Use of word limited: in case of private company, the word privately limited must be used in the end of the name of a company, but the word limited is used at the end of the name of public company. Legal formalities: a private limited company is required to observe a less number of legal formalities as compared to public company. For example, a private company is not required to call a statutory meeting and to file a statutory report to register of companies. A public company need not send the list of directors to directors consent to act as such. A director's contract to take up qualifications, shares etc. to the registrar of companies. Application for shares or debentures to be dealt with on the stock exchange. It is obligatory for a public limited company offering shares debentures to the public for subscription by the issue of prospectus to make an application before such issue to one or more recognized stock exchange for permission or such shares or debentures to be dealt with on the stock exchange or exchanges. The name of each of the stock exchange to which the application will be made has to be mentioned in the company's prospectus. No such obligation is imposed on a private limited company. Restriction regarding managerial remuneration: public limited companies cannot pay managerial remuneration in any financial year more than 11% of the net profit of the company for that financial year, but no such restriction applies in such a private limited company. Formation of a company: formation of a company, any 7 or more person or where the company to be formed will be a private company. 2 or more persons associated for any lawful purpose may be subscribing their name to a memorandum of association and otherwise complying with the requirements of the Companies Act form an incorporated company without limited liability. Following documents are to be filed with the registrar of the joint stock companies of the state in which the registered office of the company is to be situated. Memorandum of association, at least 7 persons or 2 persons or 1 person as stated earlier, each promising to take at least one share must subscribe their names to the memorandum. As per Section 4 of the Companies Act 2013, the memorandum of a company shall state name of the company with the last word limited. In case of a public company, limited company, or the last word private limited in the case of a private limited company, provided that nothing in this clause shall apply to a company registered under Section 8. The state in which he registered office of the company is to be situated. The objects for which the company is proposed to be incorporated, the liability of the member of the company, whether limited or unlimited, the amount of share capital with which the company is to be registered. The memorandum of a company shall be in respective form specified in table A, B, C, D, E in Schedule 1 as may be applicable to such company. Articles of Association. As per Section 5 of the Companies Act 2013, the articles of a company shall contain regulations for management of a company. The articles of a company shall be in respective forms specified in table F, G, H, I and J, Schedule 1 as may be applicable to such company. Company may adopt all or any of the regulations contained in the model articles applicable or to such company. A statement of the national capital. In case it exceeds 1 crore, a certificate from the central government for permission to the issue of capital. A list of directors with their name in full, addresses and occupations and ages. If a separate list of directors is not filled, subscribers to the memorandum are deemed to be the first directors. If directors are appointed by the articles or named in the prospectus, their written consent to act as directors and written undertaking to take up and pay for the qualification share, if any. Note: requirement as given in 4 and 5 above do not apply to private company. Notice of address of the registered office. This may also be given within 30 days after the incorporation or on the day from which the company commences its business, whichever is earlier. A statutory declaration by an advocate of the Supreme Court of High Court or an attorney or pleasure entitled to appear before a high court, or a chartered accountant practicing in India and who is engaged in the formation of the company, or by any person who is named in the articles as director, manager or secretary or of the company, or by any person who is named in the articles as director, manager or secretary of the company, that all the requirements of the law for registration have been duly complied with on filling the above documents and the payment of necessary fees. If the registrar is satisfied that everything is in order, he will register the company and issue the certificate of the incorporation. This certificate brings the company into existence as a legal person. It grants a legal personality, corporate existence, the perpetual succession to the company. Commencement of business. A private company or a company having a no share capital can commence business as soon as it is incorporated. A public company must obtain certificate of commencement of business from the registrar before it can commence business. The registrar will issue certificate only when shares up to the amount of minimum subscription have been allotted. The directors have paid the amount due from them on account of shares. The company has filed a prospectus or statement in lieu of a prospectus with the register and a statutory declaration of compliance signed by a director or a secretary has been filed with the register. Prospectus. A prospectus means any document described or issued as a prospectus and include any notice, circular, advertisement, or other documents inviting deposits from the public or inviting offer from the public or the public for the subscription or purchase of share in or debentures of a body corporate main contains the prospectus or main objective of the company with the name, address, description and occupation of the signatories of the, or to the memorandum, and the numbers of shares subscribed for by them, number and classes of shares, and nature and extent of the interest of holders thereof in the property and profits of the company, the number of redeemable preference shares intended to be issued and the date of redemption, or where no date is fixed, the period of notice required for redeeming the shares and proposed method of redemption, the number of share if any fixed by the articles as the qualification of a director and the remuneration of the directors for the services, the name, occupation and addresses of directors, managing directors and manager together with any provisions in the articles or a contract regarding their appointment, remuneration, or compensation for loss of office, where share are offered to the public, the minimum subscription, which means the amount which in the option which in the opinion of the promoters must be raised to provide for the price of any property purchased, to purchase preliminary expenses, underwriting commission, repayment of money borrowed for these purposes, and working capital. The time of opening of the subscription list should be given in the prospectus. The amount payable on application and allotment of each share should be to be stated if any prospectus is issued within 2 years. The details of the shares described for and allotted, the particular about any option or preferential right to be given or to any person to subscribe for shares or debentures of the company, the number of shares or debentures within the 2 preceding years been issued for a consideration other than cash, particular about premium received or shares within 2 preceding years or to be received, where any issue of shares or debenture is underwritten, the names of the underwriters and the opinion of the directors that the resources of the underwriters are sufficient to discharge their obligation. Particulars about vendor from whom any property has been or is to be acquired by the company, and the price whereof is to be paid out of this issue, the amount or rate of underwriting commission. Preliminary expense amount or benefit paid or given within 2 preceding years or intended to be paid or given to any promoter or officers and the consideration for the same. Particulars as to the date, parties and nature of every contract appointing or fixing the remuneration of managing director or manager whenever entered into of every other material contract entered into by the company within 2 preceding years outside the ordinary course of business carried on or intended to be carried on by the company, the name and addresses of auditors if any of the company, full particulars about the interest if any of every directors or promoter in the promotion of the company or in any property acquired by the company within 2 years of the date prospectus or proposed to the acquired by the company, where the shares are of more than one class and the rights of voting and rights as to capital and dividend attached to several classes of shares. Nature and extent of restriction imposed by the articles on the members in respect of the to right to attend, speak, or vote at the meeting of the company, or the right to transfer, or on the directors in respect of their powers. In the case of company which has been carrying on business, the length of time during the business which has been carried on for less than 3 years, the length of time during which the business has been carried on. If any reserve or profits of the company have been capitalized, particulars or capitalization any and particulars of the surplus arising from any revaluation of the assets of company. A reasonable time and place at which copies of all accounts on which the reports of our debtors is based may be inspected. Book of accounts. A According to the section 128 of the Companies Act 2013, every company shall be required to keep at its registered office books of accounts. These books are to be maintained in such a way so as to disclose the sums of money received and expended by the company, and the matters in respect of which the receipt and expenditure has taken place. All sales and purchase of goods and service of the company, all assets and liabilities of the company, in case of company pretending to any class pertaining to any class of companies engaged in production, process, manufacturing, or mining activities. Such particulars relating to utilizing materials or labors or to other items of cost as may be presented in such class or companies is required by the central government to include such particulars in the books of account, provided that all or any of the book of account aforesaid may be kept at such other decision. File with the registrar a notice in writing giving full address of that other place. If proper books of accounts relating to transactions effected at the branch office are kept at that office, and proper summarized written periodically are sent by the branch office or the other places as decided upon. Proper books of accounts shall not be deemed to be kept with respect to the matter specified thereon. If such books are not kept as are necessary to give a true and fair view of the state of affairs of the company or branch office, as the case may be, and explain its transactions. If such books are not kept on accrual basis and according to the double entry system of accounting, the books of account and other papers shall be open to inspection by the directors during business hour. The books of accounts of every company relating to a particular period of not less than 8 years immediately preceding a financial year, or where the company had been in existence for a period less than 8 years, in respect of all the preceding years together with the vouchers, shall be kept in good order. Statutory books, statistical books, and division of share capital, and difference between reserve capital and capital reserve. Okay. Statutory books are those which a limited company is under statutory obligation to maintain at its registered office with a view of safeguard the interest of of shareholders and creditors. Main statutory books are register of investment held and their names, register of charges, register of members, register of debenture holder, annual returns, minute books, register of contracts, register of directors, register of directors, shareholdings, register of loans to companies under the same management, registrar of investment in the shares and debentures of other companies, register of fixed deposits, index of numbers where the number is more than 50 50 unless register member itself affords an index of debenture where the number is more than 50 unless the register of debentures itself affords an index. Foreign registers of members and debentures, if any register of renewed and duplicate certificate. Statistical books in in order to keep a complete records of numerous details of certain transactions and activities of the companies, the following statistical books are usually maintained by joint stock companies. In addition to the statutory books, the keeping of such books is optional. The main books are share application and allotment books, share application and allotment book, share call book, share certificate book, and debenture application and allotment book, debentures call book, register of share transfer, dividend book, debentures interest book, register of documents sealed register of share warrants, dividend mandates register of debenture transfer, register of powers of attorney, agenda book, register of lost share certificate, register of directors attendance. Division of share capital. No trading concern can run without capital. The capital of a company, known as share capital, divided into different units with definite value called shares. The main divisions of share capitals are nominal or registered or authorized capital. The amount of capital with which the company intends to be registered is called registered capital. It is maximum amount which the company is authorized to raise by way of public subscription. There is no legal limits on the extent of the amount of unauthorized capital. Issued capital, the part of the authorized capital which is offered to the public for subscription, is called issued capital. Subscribed capital, that part of issued capital for which applications are received from the public, is called the subscribed capital. The quantum of issue, whether through a right or public issue, shall not exceed the amount specified in the prospectus. Letter of offer. Retention of oversubscription is not allowed under any circumstances, called up capital. The amount on the shares which is actually demanded by the companies to be paid in is known as called up capital. In other words, it is that portion of the subscribed capital which has been called up by the company. Paid up capital. The part of called up capital which is offered and is actually paid by the member is known as paid up capital. Paid up capital is the amount which is to be added to the total of the equity and the liabilities, as it is the actual capital which is received from shareholders. All other divisions of the capital are given for giving information to comply with the legal requirements of Schedule 3 as given in the Companies Act 2013. Amounts of all divisions of capitals are shown under the head of shareholders funds, but a line is drawn below the amount of each divisions of the capital except paid up capital, so that the amounts of other divisions of capital except paid up capital are not added to the total of the equity and liabilities reserve capital. A company may determine by a special resolution that any portion of its share capital which has not been already called up shall not be capable of being called up except in the event of winding up of the company. Such type of share capital is known as reserve capital. Such type of capital cannot be converted into ordinary capital without the permission of the court, and it cannot be dealt with by the directors in any other way. The creation of reserve capital adds to the financial strength of the company that is apparent on the face of its balance sheet. It is helpful to creditors because this is the amount which can be made available to them in case of need for distribution in the event of companies winding up. No accounting entries are required for the creation of reserve capital. Only A note regarding reserve capital may be given in the balance sheet. Difference between reserve capital and capital reserve. Okay. Difference between reserve capital and capital reserve. Basis nature. It is a part of uncalled capital, and nature it is a part of uncalled capital requirement. The Companies Act 2013 now here requires the creation of reserve capital. Procedure: to create reserve capital, the company has to pass a special resolution. Disclosure: it is usually not shown in the balance sheet. A note may be given for this. Time of receipt. Being uncalled capital, the amount is receivable only at the time of liquidation of the company. Application or usage. Application or usage. It is generally used only at the time of liquidation of the company it requires. Capital reserve. It is the accumulated capital profit. Example: gain or sale of fixed asset, gain or forfeited shares. For transfer requirement. For transferring the amounts of various capital profits, the capital reserve account is required to be opened in the books of the company. There is no such requirement for the creation of capital reserve. It is shown under the heads of reserves and surplus in the balance sheet. The amount of capital reserve is already received. The reserve can be used to write off all the capital losses or for issue of bonus shares, etc.